Now here's kind of an ironic video. You know the old saying, the kettle calling the pot black? Deutsche Bank says world past the point of no return in the default cycle, according to Zero Hedge. In other words, the kettle calling the pot black, a essentially defaulted bank, Deutsche Bank, massive derivatives, massive debt, tiny amount of assets. Again, it's essentially a dead man walking. So speaking of defaulting banks and companies and whatnot, isn't it ironic that Deutsche Bank says world is past the point of no return in the default cycle? Over the past year, the credit cycle finally turned and has unleashed the latest default cycle. In fact, as Bank of America's Michael Kontopoulos warned last week, it may be the worst default cycle in history, with cumulative losses over the length of the entire cycle could be worse than we've ever seen before. Over the weekend, the Financial Times got the memo with a report that global company bond defaults at highest level since the last time around, 2009, in which it said that the global bond default rate by companies is running at its highest since 2009, with the United States accounting for the vast majority. USA. According to rating agency Standard & Poor's. A further 4 defaults this week, with the 3 coming from the troubled oil and gas sector, pushed the overall tally to 40, with a little over a quarter of 2016 done. To be sure, the U.S. default cycle is bad and getting worse, but how much worse? The latest to attempt that answer is DB's, or Deutsche Bank's, Jim Reed, who in his just released 18th annual default study explains why his late cycle fears continue to build. These are some of the highlights. There are clear signs the cycle is turning, especially in the United States. Our U.S. strategists have previously suggested that we need the combination of 3 conditions for us to be confident the next default cycle is imminent. We need the accumulation of excessive debt, and preferably of deteriorating quality, some kind of external shock or trigger, and tighter monetary policy / a flattening of the yield curve. The pieces of the jigsaw are building. U.S. corporate debt accumulation now compares with that seen prior to the previous default cycles. Equity volatility has seen 2 spikes in the last 12 months, August and early 2016, last 12 months. Bank equity is falling, a lead indicator of lending, and global yield curves continue to flatten. The buildup of excess is often a prerequisite for bubbles to burst, or for economic cycles to be vulnerable to shocks. One argument for why this U.S. economic cycle might still be able to run for a few years is that many economists feel that excess hasn't been as prevalent as in prior cycles. However, one can argue there has been a sizable increase in U.S. corporate debt since the GFC, comparable to increases prior to previous default cycles. And as Figure 15 shows, in the modern era of leveraged finance and debt cycle waves have been well correlated to defaults. And I'll open that up a little bit for you to take a peek. And you can see, sure enough, the tech bubble, 2007, 2008 bubble, it sure enough looks like it does go hand in hand. Our U.S. credit strategists measure the total growth of debt stock as well as its aggressiveness to determine whether there has been sufficient material created to feed the next wave of defaults. Figure 16 looks at the growth of the stock of U.S. high-yield debt as well as the aggressiveness of new issuance. The former is measured by the combined size of the high-yield bond market, USD developed markets, and loans on U.S. bank balance sheets. The graph shows distinct periods of debt growth in the past, going back to the late 1980s, with each of the past 3 complete credit cycles preceded by waves of new debt creation, lasting from 4 to 5.5 years and resulting in cumulative debt stock growth of 53 to 68%. The current episode, measured since early 2011, has lasted 5.2 years and resulted in a 64% growth in the combined value of the high-yield bond market and loans on bank balance sheets, putting it comfortably inside the range of our previous cycles. It shows a similar result to our own corporate U.S. debt/GDP chart. So, first, take a look at that. 1986, debt growth cycles, high yield market size plus bank loans, U.S. dollars in trillions. 1986 to looks like around 2015, maybe 16, pushing 2016. Okay? This is the kind of stuff I like to talk about. Hard numbers, it's simple math, it's a chart, it shows you these things don't lie. Governments do, their fake unemployment numbers do, their fake everything numbers do. So, for a measure of aggressiveness in recent issuance trends, our U.S. strategists look at CCC-rated issuance, or triple C, in high yield and leveraged loans as a percentage of total market size, as shown in the right-hand graph of Figure 16. Volume is presented as a percentage, blah, blah, blah. Shaded areas highlight previous debt growth cycles. The previous 2 credit cycles in the late 1990s and mid to late 2000s saw this indicator expand by 20% and 18% respectively, compared to its present value of 17%. Unfortunately, there is a lack of detailed issuance data to extend this to the first cycle in the late 1980s. Bottom line, we can therefore conclude that prerequisites for the next default cycle are absolutely positively now in place. It says, from the conclusion, the artificial ingredients keeping defaults below their 1983 to 2003 levels are still broadly in place. So although we expect the next default cycle to be round the corner, it could still be mild relative to the early 90s and early 2000s cycle, and even the already subdued 2009 cycle, which was very short, especially given the economic wreckage seen. But how much money and crap was printed at that point? Holy crap. As we've suggested in previous editions of this report, this is likely due to the increasing artificial demand for fixed income seen over the last 15 to 20 years, which effectively allows more financing opportunities for levered companies at lower yields than they might be asked to pay if global fixed income markets were a perfectly free market where the only consideration was relative value. Obviously, the oil and gas sector will play a big part in determining the overall level of defaults. That's for sure. It says, however, if we do see a recession, even if defaults are relatively subdued, the illiquidity of financial markets could easily see big mark-to-market losses. Recessions tend to bring big overshoots in credit spreads relative to default risk away, so lower structural defaults may not provide comfort in the heat of the next recession, but current spreads should give longer-term investors some comfort across vast majority of sectors. And the final comment was, all of which perhaps explains why the European Central Bank is well on its path to monetizing junk bonds once it is done with investment-grade corporates.